Good afternoon. My name is Campbell McCreary. I'm a Vice President, Capital Markets at Amvest Capital in New York. Welcome to the Amvest Capital Inc. live webinar with Colonial Coal International Corp. Colonial trades on the TSX Venture as CAD and as CCARF on the OTC. I hope you'll enjoy today's program. It will also be available in replay mode. Feel free to chat in your questions in the question pane of the GoToWebinar control panel or simply email them in. We'll try and ask the questions in real time or after the webinar. Amvest Capital is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. Very important, this disclaimer, this call is for informational purposes only. We have with us today presenting Mr. Dave Austin, the CEO, President, Director, and Chairman of the Board of Colonial Coal. Dave has served as the President and as the Director of Colonial Coal since 2005 and as the CEO and Chairman of the Board since 2008. Dave co-founded and built Western Coal Corp, which was sold to Walter Energy in 2010 for 3.3 billion Canadian, and is credited with the exploration, development, and sale of Northern Energy and Mining, NEMI, to Anglo for plus 400 million Canadian. Following the formal presentation, members of Amvest Capital will ask questions of management, and we really hope you'll send them in to us, and we'll ask them or incorporate them into our line of questions. So, how you doing, Dave?
I'm doing fine.
Excellent. Excellent. You have the floor.
Thanks very much, Campbell.
Thank you.
I'm not particularly good at read along with me, but that's what you're going to have to do for a short period of time. I'm going to try and get it so you understand what this is all about and why I'm doing what we're doing today. I'm just going to skip through the presentation and get to the pages which I consider important. The legal disclaimer, if you don't mind, you can read in your own time. I've read it once in life and it was boring enough. The first page we're going to discuss is page 2. Page 2 basically just shows you where we are. The port that we use is Prince Rupert. There's 2 ports in the south, which is Ridley Terminal and Neptune. Most of the product, and I'll cover it really early on, the product that we produce is what we call a premium hard coking coal. Now, we're not a producer, but that's what the product comes out of BC is. Most of it goes into the Japanese market. It's been historically going there for about 40 odd years, maybe a bit longer than that now. I'm going to jump to the next page, which is page 3. And on the bottom left-hand side, it shows you that by some strange coincidence, we actually measured it. And it turns out we're 4 kilometers quicker to Japan than it is from Australia. That really won't make an awful lot of difference in life, but it does mean that we're competitive when it comes to transportation. On the right-hand side, it shows you what's happened in the past. Now, I've been fortunate enough, I founded Western Canadian Coal with Dave Fawcett and Kevin James. We took it from inception, we took it right through, did some acquisitions on the way and took it into production. And then some Australian gentlemen joined us, and they quite frankly brought a lot to the table, helped us get it put together, and we got it sold. At the same time, I had a company called NEMI, Northern Energy and Mining. I also took that from inception into production and sold that to Anglo America. Both on the right, you'll see what they sold for. In the area now, you see that Glencore, Winsway, which is a Japanese group, Glencore, Nippon Steel. There's been a bunch of different things happen. Now, sorry, I just went past the page I wanted. But at the bottom, you'll see there's been a couple of new transactions. There's a Riversdale transaction, the Jameson transaction. Now, they're relevant to what I'll be bringing up next when we get to that page. But I actually think one of the most important things is not necessarily just the properties, obviously. It's the management team. With the management team that we have, we've been successful in the past. I've worked with quite a few of these people in the past, but last November, Mr. Bhattacharyan, who used to be the chairman and CEO of CIL, came in to see me. We have been in discussions with CIL prior to that, we had a discussion about what he could bring to the table, and we were able to come to an arrangement. Now, that arrangement is obviously in place, and the idea is for Mr. Bhattacharya to help us find a buyer or potential buyer out of India, all through a lot of different companies that he got to know quite well when he was chairman of CIL. On the board as well, we have Greg Waller. Greg used to be with Tech. He is relatively new to the board. He also brings a lot of experience dealing with coal companies, and he also helps me understand what goes on in regards to the competition that we have in Canada. Ian Downing is one of the best negotiators I ever met, and he brings a lot of skills and helps me with different, let's say, different concepts of how to do things. I'm John Perry. John has done every single drill program that you can think of in Northeast. He ran the Belcourt-Saxon joint venture for us. We did a feasibility study with Western Coal and NEMI on the Belcourt-Saxon joint property. That also at that time included the Huguenot property. So he knows every drill program that's been done, going back to Denison right through Western Coal and NEMI. Now, the next page we're on, we actually just doing a comparison here, and what I'm looking at is the Grassy Mountain transaction, which is the transaction which was sold to the Australians. They sold it for $3.78 Australian. That's approximately about $3.60 a ton in the ground. What we're doing is we're just showing a rough comparison of how the Huguenot and the Gordon Creek, which is the flatbed property, compared to them. And obviously those prices are extraordinary. We'd be obviously very pleased if we got anywhere close to that, but we also realize that there's sometimes other things that go on in the transaction which would have an effect on why they paid that amount of money. Now, on page 6, there's a comparison between all the different coal companies and where our assets stand. The ones on the left, which is Canadian Dewar and HT Mining, they're Chinese companies, and they're not required to be 43-101 compliant. So those two figures they put out, it's really questionable. It's not just questionable, I just don't believe it's real. But if you look at the rest of it compared to what we've got compared to Teck and Glencore, we've got over 700 million tons, or approximately 700 million tons on our two combined assets. The next page, which is page, it jumped on page 7. What we're doing here is we're showing you all the different coal deposits in the area. Now, quite a lot of them, I can honestly say we started. Most of the ones in the top, which is the Willow Creek, the Brule, Wolverine Creek, and the Herman and Skunk, they're mostly in the north. All our properties are in the south. And the general rule of thumb in this particular coal deposits is as you go from north to south, the coal quality gets better the further south you get. Now, in the big scheme of things, it really allows you to sell the product. You're going to get more or less the same price, maybe a $1 or $2 premium, but most of the time it's the same price. You'll see it says Roman Trend. That's what I sold to Anglo. The Quintet, it belongs to Tech. They have the property beside us again, and the Belcourt-Saxon's at the bottom, and you'll see the yellow piece in the middle there. That was us. That's our Huguenot property. Now, the Huguenot Pit is adjacent to Anglo. Anglo is immediately to the top of us and to the south. We've spent about $16 million drilling out the coal deposit. We have about somewhere around 400 million tons on it. It's probably got a bit more than that. At the time when we did the program, the government had particular cutoffs that we had to use. Those cutoffs have now changed because the Chinese came in and they didn't actually agree with a lot of things the government agreed with, and so that our tonnage is probably a bit more than what we're saying. If you look at how we've got the licenses, which is in that kind of a dark pink, the reason why we picked up those licenses going straight up is it's important to make sure when you pick up licenses that you have to understand what happens when you go into production. When you go into production, you need to have, you know, a waste dump taken care of, your plant site, the rail, and everything else. So when you're picking up assets, we also pick up what we're going to need in the future to make this, you know, make this a viable mine. Now, this is the MPV on Huguenot. We actually cover it twice, I believe. Anyhow, it says here that we got 7.5. It's about 1.3 billion MPV. Now, this is all based on $174 US a ton coal. The price is not there. It has been. It's come back. It's on its way back up again. We expect it will be somewhere in around the 170s, probably by Christmas. Maybe a bit more than that. But the important part on that is when it's trading at 170, it's 224 Canadian, and that's important because when you look at what we need to get done on the sales side, it's easier to do. It's easier to get a price when when it's $200 a ton. Now the Huguenot property on page 13 has got the MPV of 1.56 at a 7.5% discount. We use a 7.5% discount because that's what we used in Western Coal and it's what we used in NEMI. 14 is the page. It's coal quality. The best way to describe this is our coal is the same coal as Teck would take off their property, Western Canadian Coal took off its property, and the Huguenot would be the same or better than the Trent property. So basically we all seem to mine the same seams. It's what we call J seam. J seam has traditionally been the seam that everybody seems to get the most benefit out of. Now the flatbed property is the next property. We've only drilled about 20% of it. And on page 16, if you look down, you'll see that the Roman pit and the Trent pits, those are the coal assets which I took into production with NEMI. Those coal seams fold into the flatbed property. Immediately north of that, we have the Windy pit and the Windy and the Window pit. They belong to Teck. And then you look a bit further north than that, you'll see the Quintet plant and loadout. The plant, the loadouts I built before, you can see them towards the top, and it says the PRC loadout. PRC stands for Peace River Coal, and Peace River Coal is the company which is Anglo that bought us out of NEMI. The infrastructure obviously runs right through the property. It's called the Heritage Highway, runs right through the property on the right-hand side. Bringing the rail down would be quite frankly, quite a minor cost. It's called flatbed for a perfectly good reason. It's relatively flat, obviously. It's not totally flat. But to bring it down would be somewhere around, I don't know, $15 million to bring the rail down. It's not a huge expense, but you could open it up. There is a loadout road that goes right through the property up to the loadout. So we don't really have to do too much in regards to infrastructure. The MPV on flatbed, hold on a second. Just with the wrong page, sorry about that. The MPV on flatbed is approximately 900 million. If you add the two MPVs together, we've got an MPV of about 2.5 billion on the two assets. Gordon Creek we've only drilled about 20% of it. That 300 million tons is all underground. The seams do run all the way through to Mount Duke at the south end, but we're using that as blue sky to encourage people to buy us out. If we give it to them, if we get what we're looking for the 300 million, giving them the blue sky seems like a reasonable trade-off. Coal quality comparison again is the same as everybody else's. And the final page is actually where we are. It shows we show where the coal seam comes from northeast BC right through into Alberta and then back into southeast BC. On the left is a picture of the port. The port from this picture has been upgraded. It can do somewhere around 20 million tons per annum, maybe a bit more. The rail has been upgraded, so there's no problem with the rail or with the port, and so there's lots of capability. We do have these assets up for sale. Now, it's possible that Huguenot could sell separately from Flatbed. We do have different companies. The Japanese, for instance, particularly like open pit. The Indonesians like open pit, and the Chinese like underground. So it creates a bit of a dilemma, but it's also just as likely that we could be bought out for both assets at the same time. We do have bankers right at the moment. One of our bankers is in China. He's meeting with the people that we had arrangements with last year. Because of COVID, we kind of lost some time because of a lack of the ability to actually carry on doing what we were doing. And we also have now just set up meetings with the Indian groups where they'll actually be getting together. There's been a lot of to and fro on emails and texts and WhatsApp. You know, we've done all that, but now the Indian groups have agreed to meetings, so we're trying to get those meetings taken care of over the last few days and possibly into next week. And then we're trying to resurrect some of the stuff that we had with them last year as well. There was an announcement late last year that the Indians were trying to get a deal done by March. All of that got thrown into the ash can because of the virus, and you know, I'd like to say I could do something about it. I just have all I've been able to do is just keep the wheels spinning, and that's about it, gentlemen. The upside is we should get these assets sold. It's just who it's going to get sold to, whether it's going to be the Japanese, the Indians, the Koreans. Last time around, everybody we thought was going to buy it, turns out they didn't, and we got bought out by Americans. So it could well be the same thing this time around as well. I'm not a really great presenter. That's the overview, and
we have some questions, Dave. So
sure.
Thank you for people who sent in questions ahead of time. And again, please find your way to the go-to webinar question or chat function and shoot us some questions, and you will remain anonymous, and we'll ask the question. So let's dive right in. India is engaging the Atmanirbhar Bharat initiative, which aims to source only locally. As such, India has stated they will open 12 coking coal mines with 1,000 million tons of coking coal reserves. Does this initiative eliminate India as potential buyer, Dave?
It has absolutely no effect on us. The Indian government is doing that to try and get as much coal out of the ground to meet their needs right now. Our coal assets are for their future needs. The tonnage that we have on our property is considerably bigger than most of their coal potential in India in any case. When Mr. Bhattacharyan came to see me, you know, a lot of this stuff was already out for discussion, more or less a year ago. So it's not a surprise that they would do that. It would make some sense for them to do that. But when they look at their long-term supply, and when you look at what they'll be spending on infrastructure, their local supply will never be able to fill their needs. That's why the Indian government's been, they picked up coal assets in Mozambique. They tried doing a deal that fell out of bed in Russia. Everything that we have in our coal fits their needs. So no, that doesn't affect us much.
Okay. According to the PEA for both Huguenot and Flatbed, there are significant amounts of resources not included in the life of mine plan. Mm-hmm. Are these resources not economical to extract?
When you do the PEA, it incurs the prices and costs at the time when you do it. As you go through the mine life, the cost of coal generally goes up, and some of the costs of what you've done already have come off. So, things like your overburden, your infrastructure costs, and your equipment costs are no longer there. So if you take and I'll give you an example like Sekunka, when Sekanko originally opened up, it really, like, it had about, I don't know, a 10-year lifespan. They were still taking coal off it 35 years later because the economics now worked out, so they could necessarily they could go deeper, and they didn't have all those initial startup costs. So yes, there is a lot more coal that we'll get out than what is covered under the PEA.
Okay, thank you. Gabe?
Yeah. Hi, David. So can we talk about the coal quality tests and how representative that coal quality is of the entire deposit, in case there's any doubts there?
Now, the coal quality test is done over the several drill programs. We don't just do it on one drill hole. So it represents the coal quality over all the drill holes, and yeah, and the quality of the coal is as good as or better than anybody else in their area.
Okay, and in terms of your area, do you have any concerns regarding provincial or federal policies?
Nope.
And then just one more, how does the Cleveland Cliffs and ArcelorMittal transaction affect you, if at all?
Yeah, I'm pleased to see any transaction take place, so it doesn't affect us at all, but it's I'm pleased to see transactions taking place.
Okay, thanks. Stu?
Yeah, thanks for that, David. You mentioned you've about 20% of the exploration has been completed at Gordon Creek.
Mm-hmm.
Have you showed other extensions to see how far the seams continue?
Well, some of the drill programs that were done on the south side of Gordon Creek or Flatbed go all the way down into Mount Duke. Mount Duke is actually owned by Teck Corporation. Some of those drill programs and some of the drill programs that we replicated were done by oil and gas drill programs. What we do is we then go and look at the cores of the drill programs that were done, not necessarily by coal companies, but by oil and gas companies. The ones that we replicated on the 20% that we did, the reason why we were so successful is, quite frankly, we had actually had a reasonable idea of what we were drilling. So when we go and look at the other drill programs, we know that the continuation goes all the way down to Mount Duke. Teck has done an extensive program on Mount Duke, and we did quite an extensive program with NEMI all the way down into what is the Flatbed property. And so we was right down to the edge of it. So the data that we have is readily available at Ministry of Mines and Energy in Vancouver, in British Columbia, but the oil ones are actually kept in Calgary. So by checking both of them, that's how we establish where the coal seam goes.
Understood. And then how good is your understanding, the geological understanding of any fault structures in the area?
You know, when we
Should
drill
impact your mine plan eventually.
Yeah, if, for instance, on Huguenot, we drilled it and we do know there's a fault in the middle. On Flatbed, it's dipping, but it's not faulting. It will fault at some stage or other, but it didn't show up on the drill program on the 20% we've done. Now there is, this is an area that faulting and folding takes place. Now the folding depends on how you look at it. We consider folding to be an example of a good place to start, because when you open it up, if you've got a 3-foot seam that's folded back on itself, you now have a 3 meter seam. You now have a 6 meter seam, and it means that you can use that to change your economics when you first start up. So all of these things you have to deal with as a challenge of starting up, but it's something which we've all kind of got used to in the area.
Yeah, fair enough. And then on like the sale offtake contracts, have you seen any recent sale offtakes get signed in the area that impact you? Like for product sales, not.
Okay, well, I did offtake agreements with Western Coal and NEMI. Matter of fact, we sold an offtake agreement to Mitsui Matsushima with Western Canadian Coal, and we sold an offtake agreement to Itocho on NEMI. The disadvantage of doing an offtake agreement is yes, you get money in, but you also then eliminate a whole bunch of people who could possibly buy you out. People who want to buy you out want to have control of their own sales, and they want to have the product. So I'm reluctant to do that. We have been approached to do an offtake agreement several times over the last few years, and I am reluctant to do it.
Thank you. Campbell?
Sure. As Colonial has some other assets, should we look for the company to remain independent after the coal assets were to find a buyer?
It depends on how the transaction works out, but it's possible even after we sell we sell these two coal assets, that we still would have other things we could do.
You mentioned the Indian desire to acquire assets by March of this year. That was thrown in the trash can due to COVID. Have CIL or SAIL given any indication of a revised timeline for being able to complete a transaction? Is a transaction even feasible this year?
The answer is that those meetings are taking place now.
Okay. Just one more. I've heard that some banks are not prepared to deal with coal or oil. Have you come across this, or is it a problem?
It hasn't been a problem for us. You know, we're pretty blatant who we are. You know, if you knock on the door, you know, if we didn't hide what we do, so we really haven't had that issue. But I have heard that potentially could be an issue for, let's say, somebody who wants to take it into production. Some of the people that we used in the past to help us go into production and we raise money from might not be able to come to the table this time around.
Understood. Retail investors have scarce capital, opportunity cost considered. Why coal? What makes it a more compelling bet than, say, gold or silver? So,
well, first off, you know, the pricing is very different. You don't quite get the glamour that gold and silver brings to the table, but the returns are phenomenal. Like, for instance, if you look at what happened with Western Coal and NEMI, no matter how you compare it to any other gold company, yeah, when you think that Western Canadian Coal started off for approximately $97,000, which I can't remember that amount, and we sold it, well, 10 years later for $3.3 billion. There hasn't been too many gold companies in BC that got even close to that.
okay. Thank you. Gabe?
Yep.
Sure. So maybe we just want to back up for a minute and just discuss, you know, the market itself. You know, obviously secular declines in thermal coal, and everyone talking about thermal coal as being, you know, a bad word. You know, we just want to make sure that the audience knows the distinction between this and met coal. And so if you could touch on that for a minute, and then also kind of maybe discuss, you know, you're in this every day. What are you seeing as the main driver, the main bottleneck, and the main driver to more coking coal in the market? So what's going to drive this acquisition from a macro point of view?
Okay, well, you know, the last 10 years have been pretty awful in the coal business, but what it is changing is everybody, and you're seeing it somewhat right now in iron ore prices, as we go and we want to come out of this COVID thing, a lot of governments, you know, the Indian government is talking about a $2 to $3 trillion infrastructure plan. America's talking about that. Canada's talking about it. Europe's talking about it. As soon as somebody makes the decision to spend that kind of money, it will require an awful lot of steel. For every ton of steel that they want to produce, you have to use up half a ton of coking coal. We're a coking coal company. The issues with thermal coal, quite frankly, you know, I try not to think about it because it's not my job to worry about it. My job is to look after our coking coal assets. But coking coal is a necessary product to make steel. Society hasn't quite come to the point yet where we don't want our cars and we don't want high rises, or we don't want our apartments or fridges or stoves or whatever you want to make. So as you start seeing governments suddenly put the infrastructure budgets out there, then the next thing that will take off, iron ore already has. It's already started to move. Coking coal has been coming up about $10 a week, but then all of a sudden there'll be a massive push for coking coal. Australia will fill most of it for the next year or two, and then it becomes one massive problem worldwide. 3 years out, there is a significant shortfall of coking coal.
So that sort of that supply demand imbalance that you see there, that is based on what exactly is that based on?
At the moment, the ability to produce enough coking coal to fill the market right now probably is just about there. But as soon as you start seeing the plans that the Indians have and the Chinese have, the Indians alone would need 125 million additional tons of seaborne coal per annum. And then you can imagine what China will need. You know, that's basically what you're looking for is nearly another 70% of what the seaborne coal is right now. You know, that's got to come from somewhere. Mozambique isn't working out that well for the Indian or the Chinese. Russia looks like it's capable of bringing some to the market, but the best market that's not really anywhere near what it's capable of doing is Canada. And when we look at it, that's what will happen. Now, if it turns out America does the same thing, we'll end up the same thing happening again with colonial coal as what happened with Western coal will get bought out by Americans.
Sure. And then just touch on one more before I pass it over to Stu. You know, BC has a reputation for being, you know, strict on environmental controls, even though there's lots of mining there. Have you encountered any of that? What can you comment about environmental issues or not in BC?
I try to use that as an advantage. You know, if you look at some of the maps we just went through, you'll realize that there's areas on the maps that we didn't pick up the licenses for. Well, in reality, we did. What we do is we pick up licenses that we can know that if we give it back to the government and negotiate with the government for caribou habitat, wetlands, or whatever, is we want to have a reputation of being a group that works with the First Nations, works with, you know, and to make sure the environment that we're in stays the environment that we want to leave behind. I've got that reputation and I want to keep that reputation. So when the government sits down with us, we don't go in there, you know, under the spotlight. We come out looking at one of the groups that has been successful. Incidentally, if you want to take anything into production in BC, the very first thing that you need to do, and it's where everybody else fails, is you need to get your environmental studies started immediately. You have to have at least 2 to 3 years of data before you do even file an application. You know, so when we pick up a property, the first thing we start is the environmental studies. And, you know, there's a lot of things to look at: snow impact, water, streams, rivers, selenium, all kinds of different things that you have to be prepared to deal with, and start doing it right from the get-go.
Great, thanks.
And then just back on the resources, like, is there a plan to upgrade the current coal resources classified as inferred into the measured and indicated category, particularly in the proposed underground mining area?
No. We've got enough data in the PEA for anybody who potentially wants to buy us out. In Western Canadian Coal and with NEMI, we did feasibility studies. When we got bought out, we got both companies told us that the feasibility studies were really a selling tool, but for us, are very nearly no value to them. Well, when you look at what it cost us about 25 million for the feasibility study on Western and NEMI on the Belcourt Saxon. This time around, we realized that do a comprehensive drill program, bring in the right people to do the PEAs, and then that's nearly as good as a scoping study, or maybe even better than a scoping study. So no, we don't need to do anything. If we started to do anything now, we'd be disrupting the sales process, and I don't want to do that. I want to get these assets sold.
Yeah. And then back on the environmental, what was the guy was touching on? What was the most recent project in this area that got their environmental license? If you could touch on that.
I think Conuma is applying for a property. It's just to the left of Perry Creek. They've just applied for that, and they got theirs, I think, late last year.
That's good. That's promising for you guys and for everyone else. Campbell?
Could you just talk about your shareholders, anyone of note, and yeah, who's your cornerstone?
Well, I suspect our cornerstone is Russell Asset Management, which is Warren Irvin is the guy that administers that or looks after that. We have a few other groups, which I'm not necessarily at liberty to use their names, but I'd say we've got 2 or 3 other groups that have 10% or 15%. At least 2 other groups, possibly 3. The management group has about 22%. So we're probably somewhere around 60, 65, 70% owned by institutions and insiders.
Are there any further steps that need to be taken before you entertain bids or more bids?
No.
Are you ready to go?
Yeah, we're ready to go. We're looking at this as kind of running an auction, very similar to what we did with Western and Nemi. Now, with Western and Nemi, we actually got a bid that came in that wasn't particularly solicited. This time around, that particular group, which happened to be an Indian group, we are spending a bit more time with them to try and encourage them to bring a bid to the table. I'd like to see this done sooner than later.
Okay. Please discuss the royalty attached to the properties and its economic impact.
It has no impact. When you look at the size of royalties that people can have on a coal asset, the 1.5 royalty, most of it goes to me. I did give a portion to people that I needed to come and help me, like John Perry has a portion on the royalty. He then used a portion of his royalty to attract some of the people that he wanted to work with. So the royalty was used as a carrot to try and get the best possible people to come and join me. Now, there was one thing I forgot to cover on the management structure. Dave Fawcett, who had helped, obviously him and I started Western Canadian Coal and built it. He joined us. He's now on the advisory board, and his mandate is to, because he has a good relationship with the Japanese, his job is to help us on the Japanese side, bring a Japanese group to the table to try and buy us out. Dave and I shared royalties together on Western Canadian Coal and in Nemi, but this particular royalty, most of it goes to me.
Someone recalls that the company is or was involved in litigation for one of the ports, which could be used for shipment. What is the status of the litigation, if that's even important?
The litigation is ongoing between the First Nations, the federal government, and the provincial government. We are not participating financially in that, but the outcome will have an effect on us. There has been several different judgments made, but each time it seems to be that the litigants won't abide by the Supreme Court rulings, or they have a difference of opinion on the interpretation. We are staying out of it because, quite frankly, it's an expense that we can't afford, and we don't actually have too much input on it. We have on the outcome, we're affected, but we don't have any input on it.
Will there eventually be an urgency to get capacity at Ridley Terminal? Will the proposed Riversdale mine, 4.5 million tons per year, be taking up some of the remaining capacity?
No.
Okay.
There'll be lots and lots of capacity. That's even if Conuma doubled or tripled what they're doing today, unless say Teck opened up and put 2 or 3 million tons through, there'll still be somewhere around 10 million tons that could be put through at the current rate. I used to run ports, and that port is quite easily, they could move that port up quite quickly by putting another load out. They could move it up to 30 million tons per annum. The rail could quite easily be upgraded to 30 million tons. So there is not going to be any major issue with port or rail out of Northeast Coal.
All right, thank you. Gabe?
Sure. I'll just ask one and then maybe some audience questions. So just curious, would you ever entertain like a management buyout?
Hadn't given any thought, and yeah, I haven't given any thought. Thank you.
Okay. So question around, so it's fairly involved. So if 20%, I'm just going to read it verbatim. If 20% of flatbed has 300 million tons, is it safe to say that the remaining 80% of flatbed has 500 million to 1.2 billion? So therefore, are you going to add an amount that you decide to the 20%, giving you a total of 800 to 1.5 billion tons to sell for flatbed?
No. What I'll do is I'd like to get paid a reasonable amount of money for the tonnage that we're providing, the 300 million. So let's say hypothetically, and I'm going to give you a lowball figure. Let's say it's $1 a ton US in the ground, and they pay us 300 million. That's, I know, add 30% to that. It's pretty close to 400 million Canadian or whatever. That and the Huguenot property together would give us about 1.1 billion if we sold both assets at $1 a ton in the ground, and that's leaving the blue sky for whoever buys us out. Now, let's say hypothetically we got bought out with Huguenot and we haven't sold a flatbed, then it's possible if we got 400 million tons and we got $1 a ton, which I am lowballing that figure. If we got $1 a ton for that, we'd have 400 million. We could literally dividend out $2 a share to shareholders, and then come back and spend maybe $20 million on a drill program on the flatbed property, and let's say double or triple what we have, then we'd put it back up for sale again. But that's a plan that I'm hoping not to go down. But it really comes down to if Huguenot gets approached and we sell it first and we don't have a buyer for flatbed, that would be another alternative which we've discussed.
Great. Stu?
I know travel's hard this year, but have you managed to do any site visits, either in previous years or this year with some of the parties that would need to do that for their technical due diligence? And are any of your shareholders, have they done site visits?
So the answer is yes to all of that. I'll break it down this way. We don't need to do any site visits with any potential buyers. All of them have done their site visits. CIL's done it, Sale's done a site visit. Now, Wuhan Steel, Ann Steel, and Fushan have also done site visits. So all the potential, including Vizag, have done their site visits. Japan, the groups out of Japan would not need to do a site visit because they've been buying coal from this area for 40 years. The Koreans have already done their site visit, and the Indonesians have done site visits. So the answer is we don't need to do that. Potential shareholders or shareholders have been up on the property. Over a period of time, we've had major shareholders wanting to do site visits, and we've arranged those site visits.
To that. And can you speak to the relative desirability of your coal versus other properties in Western Canada? And can you confirm the potential suitors' understanding of that quality difference?
Well, ours is a premium hard coking coal. The coal seam that goes from Northeast Coal goes into Alberta, goes to Grand Cache, and then back down again into the Crow's Nest district of British Columbia and Alberta. It's basically a premium coking coal, whether you start an area or you pick it up in the Southeast BC. The coal quality, the good thing about our coal quality in Canada, whether it be us or Teck Caminco or whoever, is it's a coal quality that meets the specs now and going forwards. The world is trying to drop coals that cause environmental issues. Our coal is the top tier, not the top tier. The top tier coal in the world is called Peak Downs coal out of Australia. But if you think of a pyramid, Pete Downs coal is at the top. We're the ones just below it. Pete Downs coal is coming to an end. So the next tier of coal that will be around for the next 40 to 60 years will be us. And we have enough coal to be around for the next 60 years to 100 years.
Got it. Thanks for that. How could you compare like the infrastructure in the area compared to your previous companies that you've had success with?
Well, you know, everybody has its challenges. With NEMI and with Western Canadian Coal, we had to build the infrastructure. Some of that infrastructure that we built actually benefits, like, for instance, the flatbed property. The trend mine, we literally had to put a loadout road in, and that loadout road can be now used by the trend by flatbed. The Huguenot property, there's a feasibility study that was done by Canadian National Railway, and it shows what it's going to take for it to come down. That feasibility study was paid for by CN and by the provincial government, and it shows that the infrastructure would come down to Mount Duke and then further down to Belcourt South and then to us. That cost would actually be picked up by CN and then distributed back to the producers over the life of the mine. So basically like a tariff that you have to pay per ton for a CN to recover their costs. The road is already there, the heritage highway is already there. The scenarios that we've come up for on different transportation alternatives is that we could use the heritage highway and bring it all the way up to the existing loadout, which is up where the CN rail is, where it is today, and we'd utilize that to make sure that we had enough cash flow to pay for everything as we went along. That's a standalone idea that we came up with. If everything else failed, how would we take this into production at the minimum amount of money? Now, Western Coal and NEMI, we had to do that. We will not have to do that with Colonial Coal.
And that proposed rail loader, like when may that occur? Like, is there have people given a timing?
Well, it really comes down to what plan you're willing to do. And so we wouldn't necessarily put rail in. You know, there is overhead tramways. There's a bunch of different ways that we could bring the coal out without necessarily bringing rail down. We don't want to do anything that could cause environmental issues. An overhead tramway might actually be better than a rail. So I don't want to answer that and say that's the alternative we're going for. It is one of the alternatives that we've done in our PEA.
Yeah, and is CN Rail the owner of all the railways in the area, or there's some private ones?
But it doesn't mean that, like for instance, we have spoken to different railway companies that are willing to build the rail and link it in with the CN. And the law says that CN has to allow them to do it. Matter of fact, we met with Chinese National Railway. They are one of the parties that are interested in putting the rail in. And the irony is when we get bids from them on what it will cost to go in, it is significantly cheaper than CN.
Yeah, so you don't have that problem like in iron ore in the Pilbara in Western Australia where
No.
Hancock, Jane Reinhardt, Fortescue, BHP, Rio all had to build their own railways. Yeah.
Ours, because of the way it's set up, we actually, it's mandated that we actually, if we, like for instance, the flatbed loadout and the PRC loadout, the government actually encourages companies to utilize it and share it.
Yeah, it makes much more sense for everyone. Thanks, Gabe. Did you have one more?
Sure. Yeah, I just wanted to maybe touch on, the pressures in a buyout transaction, and sometimes, being a public company can work for or against you. So I wanted to touch on, if you're seeing anything. Well, first, obviously we're here on this to tell people there's an opportunity in the shares. But have you seen any sort of foul play or any sort of manipulation? Let's not use that word, but let's say any sort of stuff that's weird or strange in your stock price, given that's the main tool for a acquirer to use. I mean, apart from obviously your studies, but they're always going to create the disconnect between your study value and the stock price. So can you just comment a little bit about that?
Yeah, well, the answer is I'm not going to answer that question the way you phrased it. I will answer this. With NEMI, we had an issue. We were in negotiations with Anglo, and Anglo decided that it made some sense for them to go and buy stock out of the market, which they did. They bought very nearly 20%. They then encouraged another party that they worked with to buy a percentage. And so when we got bought out of NEMI by Anglo, they actually got to buy back. Obviously, they paid themselves back a big chunk of money. In the particular scenario we're talking about right now, I'm afraid I can't comment on that. There's a reason why I can't. So I'm sorry, I can't answer that question for you.
Okay, I appreciate the comment. Thank you. Okay.
You say you are now open for bids from suitors, but previously had been waiting for important parties to come to the table. As of when did you communicate you're open to bids?
We've been communicating that over the last short while, but that doesn't mean we want a low ball bid. It means that we would like to get in a discussion about where to start.
Okay. Have you seen the Australians showing any interest in the project?
Yes.
Okay. And are we correct? 187 million fully diluted shares. About that correct?
184 million, give or take.
Okay. Let's hypothetical case. What would be the process following a potential bid? How would that play out? What would we see?
Well, what we did with NEMI, and I'll use NEMI because we halted the stock. We made the announcement. We tried to organize an organized market to bring it back on again. Unfortunately, we weren't able to do that, so we ended up halting it again. And in the end, we realized we were going to have to use computer share at that time. I think it was Montreal Trust and computer share. And we came to the conclusion it was better to allow people to tender their shares through their broker to computer share and get their money. With Western Canadian Coal, it was a bit more complicated because theirs was a 70% cash, 30% exchange of stock, and a bunch of other transactions. So that was a bit more convoluted, and I really couldn't explain that in the short time we've got left. And I don't want to explain it because, quite frankly, I'm not sure I got mine right.
Okay. And I suppose we've had a few comments sort of, so when are we going to see a deal? So you can't quite answer that, but when you pass people on the street and they say, when are we going to see a deal? What do you say?
As soon as I can.
Okay. Want to thank everyone for tuning in today. Thank you for your questions. We'll be queuing you for follow-up and feedback rather, and we would really appreciate it. And I know Dave would. And please, you can follow Colonial on the usual social media places. You can follow Amvest Capital as well, see upcoming events, and feel free to follow up with us and Dave with any follow-up questions or any requests for individual meetings. And with that, Dave, you have the floor for a closing statement, closing remark.
Yeah, I just want to say thank you. I was intimidated by the amount of people on the call. I find it hard to imagine so many people being interested, but I do appreciate you showing the interest. I want to thank the shareholders who are existing shareholders, and I do care about all shareholders. There's people who've already got their money in, and we're going to try and get the best possible deal we can. I'm a little bit on the greedy side on this one myself. I want to achieve what I tried to set out for in the beginning, and I think it's just a matter of time before we get it done. Thank you.
Thank you. Good day, everyone.
Thanks.
Thank you.
Thank you.